Here's a truth you probably aren't ready to hear. Your health insurance costs are about to get significantly more expensive, and this time, it's not just a temporary bump. If you're covered through your job, brace yourself for a financial hit in 2026 that could strain your budget even more than you anticipated. But here's where it gets controversial. While overall inflation has slowed compared to the wild spikes of recent years, employers are preparing for the largest surge in health benefit costs in over a decade. According to Mercer's latest survey of employer-sponsored plans, the average premium increase is expected to land between 6% and 7%. That means more money deducted from your paycheck, higher out-of-pocket expenses at the doctor's office, and a growing pressure on workers already grappling with stubbornly high prices. And this is the part most people miss. Companies aren't just raising premiums. Many are shifting the burden by hiking deductibles and copays, effectively asking employees to pay more upfront for care they might desperately need. Beth Umland, a senior researcher at Mercer, explains it bluntly. Healthcare isn't just getting pricier. People are using it more. During the pandemic, employers absorbed some of the rising costs to shield workers, but that generosity is fading fast. Nearly 60% of companies now plan to trim expenses by forcing employees to cover more of their own healthcare, up sharply from 44% just a year ago. What does this mean for you? Open enrollment season, when you'll finalize your 2026 coverage, is coming, and the options might look drastically different. Some employers are introducing plans with wider networks of doctors, but steeper out-of-pocket fees, while others are pushing workers toward high-deductible plans paired with health savings accounts. But here's the twist. Even if you choose a cheaper plan, you might still face hidden costs. For example, the skyrocketing use of GLP-1 drugs like Ozempic for weight loss and diabetes is driving up employer expenses. Nearly 80% of surveyed companies have seen a surge in prescriptions, and many are now requiring prior authorization or mandatory weight management programs for coverage. And this is the part that's sparking debate. Should employers even have the power to dictate how workers access their medications? Meanwhile, cancer care remains the single biggest driver of cost increases. Rising diagnosis rates and the astronomical price tags of new treatments are forcing companies to expand preventive services like breast cancer screenings and alternative colonoscopies. Yet, critics argue these measures are a band-aid solution. The story this year is more alarming than ever, says Ellen Kelsey of the Business Group on Health, highlighting how actual healthcare costs have consistently outpaced projections. Adding fuel to the fire, President Trump's proposed tariffs on imported goods and his big, beautiful bill could further disrupt healthcare access and affordability. While the full impact remains unclear, one thing is certain: workers are bearing the brunt of these changes. And here's a thought-provoking question to chew on. Is it fair for employers to pass these costs to employees when rising healthcare expenses are tied to broader systemic issues like drug pricing and policy shifts? We want to hear your take. Do you think companies should absorb more of these costs, or is this simply the reality of a broken system? Share your thoughts below.